Hey, Dan Passarelli here. There's a type of option that a lot of people talk about and a lot of people have questions about because they're not as common as some of the other ones. And they're called LEAPS. LEAPS are long-term equity anticipation securities, which is really just a fancy made-up phrase for options that have a long time until expiration. When they're first listed, they can have up to almost 2.5 years until expiration. They're still considered LEAPS until they have about 1 year left, and then they just sort of morph into regular options. When would we use them? Well, let's take a look. So here's a chart of PayPal. If we go to, let's go to a 1 year version, we see, oh boy, so, 8 months ago it was down here around 57. It got up here. And maybe we think for whatever reason, PayPal or the market in general is going to stay low for a bit, but it could grind higher over the next couple of years. But hey, I don't want to risk my money by buying shares of it. I'd rather own a call. So what we can do is go to some of these really long-term options here, like these January ones. Oops, let's get rid of this. These January of 2027 ones, which have just under 2 years until expiration. If you're watching this close to the time I recorded this a little bit ago. So here I could just go and I could buy like these 70 strike calls, or it's actually even more common to go a little bit in the money, maybe these 65 strike calls. And sure, I'm paying over parity, but you get what you pay for. I'm getting all this protection for 2 years. And if the move happens faster, I can easily close out of these. I'm probably not going to hold these for 2 years. But what's nice about it is even the at the monies, they have a much higher than 50 delta. So when they do go up, I can go in there and, I can take my profits sooner. Another couple nice nuances about it is their thetas are paltry. I mean, when there's a lot of time until expiration, they barely lose any money as time passes. Also, their implied volatility, while their vegas are definitely very big, the actual implied volatility itself doesn't change very much. What a lot of people like to do with LEAPS is buy the in-the-money LEAPS and then sell an out-of-the-money short-term call and keep rolling. That's a poor man's covered call. Now, there is one thing about LEAPS that you do want to know about, especially in this market environment where the interest rate changes, is that LEAPS are affected more by rho, the interest rate sensitive Greek, than shorter term options. When interest rates go up or down, it'll affect those LEAPS prices more than a regular option. I hope that helps. This is Dan Passarelli. Trade smart.